Hello, everybody. Thank you for joining us for this morning's webinar. Sorry, we're starting a slightly late there, technical difficulties. For any of you that are new, please remember to go to our website and to sign up to subscribe to our emails, because we recently had to change our platform for that. And so if you don't sign up and if you do not respond to the opt-in email, you will not receive our emails. And you're definitely going to want to pay attention to our emails for the next 6 weeks, starting on Monday, because we will be releasing some things that Jim is discussing in his book. And he's going to be writing a little blurb each week that we want to share with all of you. And that series starts on Monday. Also, if you're new, we are having our last long format intensive this fall, and it starts on October 16th and runs through November 15th. You can go to our website, jimdaltontrading.com/courses at the top navigation here, and you'll see that the intensive is featured up at the top. You can also click on tentative schedule, see all the timings of our webinars and our topics. And also, right now, we've got limited time discounted bundles. And these bundles won't be available forever. If you have followed us for some time, you'll know that a lot of times our e-courses, they're never on sale unless we're having them in a bundle. And just another thing to mention, all of the webinars are recorded. In case you can't attend, you'll have access to your materials for 1 year after. And to join us for an intensive, you must have the prerequisite requirement of the Foundation and Application of the Market Profile e-course. You'll see we have that bundle right here. If you're just interested in the e-course, you can get details right here. If you have any questions, type them in and I'll be sure to answer them during the webinar. Okay, Jim, I will give you the screen back. I've given you the screen, Jim.
Okay. All right. Good morning. First thing I'm going to talk about this morning, we said we've got a new book coming out, and the name of the book is Markets and Momentum: How Profiling Gives Short-Term Traders an Advantage. When they do these books, and it's going to be published by Wiley. Hopefully, it's out. Their goal is to have books in the bookstore by the 15th of January. What they do, they send out promotional copy, and they have me go over it and see if I like it or not. Well, one of the things they did, they started off and they said, a veteran trader and investor. And I immediately responded back to them, I am not an investor. I am a trader. Matter of fact, one of the things that I talk about consistently is what will mess up a trader more than anything is interspersing their investment views with trading. That is, I think, one of the biggest single mistakes people make. They get something in their mind. They get something in their mind about what the market, or what the economy is long-term or intermediate term, and they then try and apply that as a trader. And I think that is a real disaster. We know that, at least from the evidence that we have, that probably we say 5 to 10%, only 5 to 10% of the traders, short-term traders, make money. I think it's more like 2%. And I think a lot of it is, first of all, is to remember the market you're trading is yourself, not the market itself. Most of our mistakes are human mistakes. But as Jen mentioned, starting next week, we're going to be, once a week, we're going to be releasing a key point that I think is very important for trading. These are things that I have developed over going on to 6 decades of trading. And I've whittled it down to the 6 things that I think are the most important for traders. We're going to do those one a week. We're doing them. It's promotion to draw attention to our intensives and our educational programs. However, if it's something that if the programs aren't of interest or affordable to you, you're still going to be able to have access to these 6 key points. And like I say, they're the things that I think are the most important over the last decades that I've been a trader. Starting off today, where we are in today's market. In order to take a look at that, let's go and look at at a bar chart. Okay. Jen, can you put your bar chart up? Mine's not coming up right away.
Oh, RJ, do you have your TUS?
I do not. I need a minute.
Oh, okay. It would take a moment then, Jim.
Okay, well, mine's going to take a moment.
Yeah.
Too. We had some technical problems. RJ, if you get there before I do.
Yeah, I'll let you know.
Okay. Okay, I'm going to do it. While we're doing that, I'm going to do it. Pardon?
My charts are up.
Oh, okay. Go ahead. Let's see them.
Okay, RJ, I'll give you the screen.
Sure.
There you go.
Okay. Can you see my screen?
Yes. Okay, and I'd like the daily bar, please. All right. If you look at the left hand, starting down at the green line, and you look at the market going up, you will see that the market, can you see my arrow? You can't, right?
Well, no, right? Because RJ's driving
Okay.
on his
So
machine.
RJ, start with the lower line on the left-hand side, touching the green line. And you'll see the market trades higher. RJ, can you, no, can you use your arrow? All right, I guess not. So on the very left-hand side, the market one time frames higher for 1, 2, 3, 4, 5, 6, 7, then it gaps 8, 9, 10, 11, 12. Then it moves sideways for several days. What is going on there is momentum traders. Weaker hands, momentum traders simply following price. Now, the market then moves higher, and for all practical purposes, it moves sideways for about 10 days. During those 10 days, there's twice that the market tried to break below those 10 days. If you hear a noise in the background, that's going by. But finally, the market breaks to the downside. That is when the market went up, it went up when you see it one time framing higher like that. It looks strong, and from a momentum trader standpoint, if you're only following momentum, and remember, momentum is only price, it looks strong. In fact, what was happening is shorter term traders were getting longer and longer and longer. The one time framing where the market so many times, the market low is close to the previous day's low, that is just a thing that short term traders, particularly momentum traders, love to buy lows. So the market moves sideways for 10 days or 12, whatever the day was. Then we get a sharp break to the downside, that liquidating break. And with the market on the liquidating break. And I say liquidation because it appears to me that is liquidation of short-term trading money that got too long, rather than a more potent combination of trading money and investment money. That is a huge distinction that needs to be made. So the market, the trend is now to the downside. But things you take into account, if you look across the highs, just below the 5,700 level, you'll notice there's no real excess up there. So many of those highs, there's about 6 of those highs that are relatively close together. That is usually an indication of inventory that is just simply getting too long. When inventory gets too long, then the short-term traders, finally something will come along and trigger the liquidation. And I think what we've seen in the current market is liquidation rather than a combination of liquidation and new money selling. Now let's go back to my screen, please.
Jim, just want to do one thing, because I think I was mistaken earlier when you were talking about the green line. You were referring to this area here where it was one-time framing.
Yes.
And then the liquidation.
Yes.
I was starting to show on this side here, which was wrong. So I just want to correct.
Let's go back to my screen, please.
Okay, let me give you the screen. There you go.
All right, so now you get this sharp liquidation, and it really accelerated following the employment numbers last week. The market got overly short, and this is what really makes it difficult for traders. What happens, momentum traders, when the market starts to break, the momentum traders jump on board and they sell and they sell and they sell. If you look, even take going into Friday, they closed the market almost on the low, and then actually after the market closed, I think the last trade was 54.04. So what happened is the market got exceptionally short. The short-term traders went from overly long to overly short. The point I'm trying to make is so much of short-term trading has to do with inventory becoming too long and too short. It happens within the day time frame, and it happens within the intermediate term time frame. So once the market gets too short, as I think it did on Friday, then there's the short covering starts to take place. Traders that are just looking at momentum, that don't understand the difference between real buying and short covering, and there is a difference, they are going on price. So now the market, you get the short covering rally that takes place. When that takes place, the momentum traders see that as strong buying, and they pile on. So we go from too long all the way down to too short, and now the market is correcting that inventory that was so very short. So you're about to open today. You've got about 15 minutes or so to the opening. You're right at yesterday's settle. The difficulty in here is that this buying from the downside here, let me stop. When a market gets too short, how do you cover a short? You have to buy to cover that short. So that brings in the potential buying. When a market gets too short, it gives you short-term strength in the market, but it's not lasting short-term strength. When that short-term inventory is corrected, then the market can turn back down. So the trend is now down. We broke from the downside. The trend is down. we have a 2-day balance. So on a very short-term basis, what you're dealing today is with short-term balance. So take yesterday and the day before, that's your 2-day balance. So the trade today is, do you break above the 2-day balance and continue higher, an upside breakout for the 2-day balance? Do you look above and fail? If you look above and fail, then the market reverts back to the downside. So the real focus this morning is on the 2-day balance. Balance is one of the most important aspects we deal with trading. Do we get an upside breakout or not? That's what we're looking at this morning. Now, Jen, before we go on and take questions, you want to do another commercial on the intensity coming up?
Sure. One moment and I'll take the screen back from you. Okay, so like I mentioned, if you are interested in reading those 6 characteristics that Jim mentioned, one starting each week for the next 6 weeks on Monday, you need to sign up for our emails here and make sure that you respond to the opt-in email. You must do that in order to receive our emails. And as mentioned, somebody asked about the intensive. Why do you have the prerequisite? It's to ensure the integrity of our intensive. The foundation and application of the market profile e-course is the prerequisite requirement. It is at your own pace e-course that is 11.5 hours long, but there's a lot of information in it. So you will need to go through it several times in preparation for the intensive. And that's what I'm letting everybody know who's doing that course, is to focus on that for now in preparation for the intensive. And if you have any questions about which course is right for you, or are you any questions on any of the courses, you can contact us, dalton@jimdaltontrading.com, or I'd also be happy to speak with you over the phone. But as I've mentioned, because this is our last long format intensive that's 4.5 weeks long, you have access to materials for 1 year after it finishes so that you can rewatch everything. And that's very convenient because we do have a lot of international clients that are not able to join us live for every single webinar because maybe of their job, or they have to sleep at some point in time, or maybe they've got day jobs for which it's not convenient to join a certain time of day. So not a problem. Just showing you the schedule here. These are posted in Eastern time, so you would need to adjust for your time zone, but it gives you an idea of the topics and things that we're covering and our special presentations. And as mentioned, we've got limited time discounted bundles available. And these will be available, I want to say, definitely through the end of this month, maybe through a little bit in early October, but they won't be around beyond that because we know that people don't have enough time to complete the foundation e-course if they have not done so already. Okay. Some questions then, Jim. I'll give you back the screen.
Let me elaborate on the question about why the prerequisite. The intensive is not a beginner's course. There have people that have been taking 14, 15 intensives. How you really learn something, it's repetition with variation. And the reason people have been in so many intensives, that each one is different. Because of the markets are different. So the course is not for beginners. We don't want to be fair to people that have been with us for a long time. But if you don't have the basics down, you're going to be very frustrated because we're not going to stop and answer basic questions because there are some really serious traders. We have institutional traders. We have some long time, big time traders in this course. Now that's the real reason. Now, to go back and don't put off lightly, Jen talked about the next 6 weeks. I'm going to be releasing one important aspect. I selected the 6 most important trader concepts that I have recognized over my many years of trading. And whether you were obviously doing it for promotional purposes, but whether you join us for the intensive or not, there still is great benefit from these 6 that are being released. I don't think you want to miss them. Okay, let me take questions, please.
Okay, somebody was asking earlier, what do you mean by the market is too long? Can you explain it in another way?
No, when we saw the first graphic and we saw the market go up for, I think it was 12 or 14 days at one time framed higher, which meaning that the low of the day 2 did not take out the low of day 1, etc. Inventory just continued to get longer and longer and longer. And people got to, they forgot about risk. They forgot about risk. Momentum trading, part of the problem with momentum trading, understand momentum trading is very important. It's what most people do in the market. But like anything else, it can go to extremes. So people blindly continue to get long short-term inventory until all of a sudden, there wasn't anybody else. And now when you get, there's so many people long and comfortable long, and then you get some bad news and you get the liquidation, and then they panic. What short-term traders, they jump on, they pile on. And if the market's going down, it's like last Friday. Look what they did last Friday. They sold it, they sold it, they sold it, they sold it, they sold it. And of course, it opened Sunday night, and they took it down for the first, few minutes, and the market's been up strongly ever since. What happened? The market broke because inventory got too long, and now the market's been going up because that inventory went from too long to too short. And now you're getting the short covering rally. And say it's not uncommon that a rally before it can break. The trend is now turned to the downside. But you've had 2 days of rally. The market got very short. So sometimes the market has to rally before it can break further because you have to bring the inventory back into balance. Now, that doesn't mean that this is what's going to happen, because now you've got something else. You've got a 2-day balance. So when the market's in balance, whether it be 10 days or 2 days or an inside day, from a short-term trader's standpoint, you apply the balanced trading guidelines. So the balanced trading guidelines are: go with a breakout from balance. So in other words, we've got a 2-day balance. The market breaks to the upside, go with it. Fade or go against an upside breakout or a downside breakout that fails. In this case, it's an upside breakout. If the market attempts to break to the upside today and fails, then the trade is more than likely to the short side. If the market just stays and opens within balance, all it's doing is further tightening the balance. And in that case, probably waiting for tomorrow's number. Today's number was pretty benign, just about what the market was looking for. So as we come into the opening this morning, we're at yesterday's settle. We're at the top of a 2-day balance, and we're going to open here shortly, and the balance trading guidelines are applicable. Okay, what else?
Okay, Jim, are you implying that the other time frame is sitting on the sidelines and not participating at all during short-term momentum trading?
No, when you phrase it and say at all, now that's obviously not true. They're always doing something. It's a question of dominating. It's, they're always doing something, but they haven't really been dominating the market. All I've seen for some period of time in here is short-term momentum traders, and I see them got too long and get too short. So it's the short-term trading that has dominated the market. Now, there was probably some liquidation of longer term money and that's probably what triggered the break from the 10 or 20-day balance. When the market began to question, was the market turning over on a longer term basis, and were we looking for better chances of a recession? But I think right now the market still, the short-term trend is to the downside, and it went downtrend, and now you're in a 2-day balance. And then you go with that 2-day balance as a short-term trader, okay? But remember what I started to say. The worst thing you can do as a short-term trader is bring your economic investment views into play relative to short-term trading. Okay, final couple questions.
Okay, another question about time frame. With the term other time frame and one time framing, the use of the word time frame is being used in different contexts. What do you technically mean by time frame in your term one time framing?
When it's one time framing, it could be long term, it could be intermediate term, it could be short term. It's just one. When I mean one time framing from that aspect, it's today's low did not take out yesterday's low. Tomorrow's low does not take out today's low. It's just a one time framing trend. Now, I haven't seen long-term money, really evident in this market for a long time. All right, so the market's open. We're within yesterday's range, so we're still within the recent 2-day balance. Okay, final question or two?
Could you go through what balance trading guidelines are?
Balance trading guidelines. If the market remains within balance, it further tightens the balance. Go with a breakout from balance in either direction, or fade or go against a breakout. Go against an upside breakout that fails, go against the downside breakout that fails. If you get a failure, the odds are that the market will trade to the opposite extreme. We talked earlier about the 10 or 12-day balance we had at the top that finally broke last week. The market twice before the real break came made 2 attempts to break to the downside. On both times, those attempts failed and the market rallied all the way back up to the top of the balance. Okay, final question.
We had more than one person asking once again about long-term traders. How do you identify, or how do you know if they're in the market or not in the market?
Okay, you learn that through experience. There's no simple answer to that. But one of the things you'll see when you see the market continually stop and start at mechanical levels. Mechanical levels may be the previous day's high. It may be half back from overnight, half back from the day, continually trading at half back from the 30-minute bar. Those are the signals of the references that short-term traders look at. Long-term traders don't look at those things. But this, you learn this through experience. And there's no simple answer. It's a most often asked question. And it's a dream everybody thinks is an easy answer to. There is not. Okay? So now remember, as we open today, the market broke to the downside a few days ago. Now it's formed a 2-day balance. So as of right now, the trend is down. The trend is down and balancing. Okay, final question.
Since we opened in yesterday's range, do you expect the market to be in balance?
Well, unless it single prints out, unless it's with confidence. You want to look and see how much confidence there is on here. Remember that the long-term trend is down in here. Right now, you're opening within the previous day's range, and if there's anything here, the market with confidence will continue to trade lower. If the market slows down here, you're coming up, just about to the prominent point of control from overnight, and you got to see what value does. But as of right now, where we're still within the 2-day balance. Okay, let's say thank you very much. And remember, for the next 6 weeks, we will be releasing one of what I consider to be the most important observations I've made over the past 6 decades. Thank you very much.
Thank you, everybody. And like I said, if you have any questions on our courses, by all means, please contact us at dalton@jimdaltontrading.com, or feel free to call so you can speak to me about that. Thank you much. Have a great rest of your day and see you next time.